welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and trends we've been exploring for you here at Quilter Cheviot. Remember, you don't need to miss future episodes. Be sure to hit the follow button on whichever streaming platform you're listening to, or by following the @QC Weekly comment on LinkedIn. I'm your host, Andrew Jones. I'm an investment manager based out of the London office. And this week I'm joined by two of our equity analysts, Chris Beckett, who normally covers the exciting subject of consumer staples, but this week is going to talk to us about macro, and our own little ray of Mediterranean sunshine, Maurizio Carulli, who has steeled himself to talk to us about oils and materials. So I'll make a start. Chris, look, I'm looking at my screen at the moment. FTSE 100 up. In fact, now it's up slightly more than 1% on the day, well more than 10,000. Oil is sitting there at, what's oil looking at? 115. Gold is roughly where it was 6 months ago. Everything's okay. We've nothing to worry about, I presume. It's all fine.
I think it's not, in a word. The war in the Middle East is still ongoing. We're into week 5. Markets are still discounting a relatively benign outcome that 5 weeks in is taking a long time to materialize. If you look at global equity indices, we're down about 8%. So it's not been a good month, but if the war goes on, and Maurizio is far more qualified than me to talk about the implications with the oil price, but the implications in a macro setting of higher oil prices leading to lower economic growth and higher inflation and higher interest rates, you can get to a pretty negative scenario pretty quickly. And those sort of more negative scenarios aren't being discounted either by equity markets or fixed interest markets right now.
And the OECD marked the Eurozone and the UK future growth down quite a lot at the back end of last week. My notepad tells me that the Eurozone was marked down from 1.2 to 0.8, and the UK, these are growth expectations, from 1.2 to 0.7. So although these growth expectations are already, I think, pretty weak, those are pretty significant downgrades, I think.
Yeah, we were already, before the war started, we weren't looking at great economic conditions either side of the Atlantic. You were getting better economic growth in the States, but doing my day job, looking at consumer focusing companies, it's a pretty weak environment both sides of the Atlantic. And if you add on to that, particularly in North America, where gasoline prices are more responsive to oil prices, that money being spent on petrol that otherwise could have been spent on other things, it's not a great macroeconomic environment. And as you say, we're beginning to get the downgrades in terms of economic growth expectations. But I think the big thing is that if we persist with $100 oil plus or $115 oil plus where we are right now for any length of time, you're going to get bigger downgrades and bigger reductions in expectations than we've seen so far.
Yeah, I mean, oil is obviously pretty elevated at 115, but I always think, yeah, some people perhaps an older generation than us will tell you that they remember where they were the day that Kennedy was shot. I remember where I was the day that oil first spiked above $100 a barrel, and it was quite a long time ago. It was something like 2005, wasn't it, when oil first went through that barrier? So I think we've got, the world economy has got used to pretty stable oil prices for quite a while, and inflation is really going to be the big killer for macro, I think.
Yeah, the inflation impact of oil prices, like the first round effects of higher oil prices, you'd expect central banks to look through. So they see oil prices and oil derivatives, the product prices going up, caused by the war. It's when the cost of everything made using oil or transported using oil-based fuels, it's where the price of everything is going up. So you think everything that you're buying in a supermarket has had fertilizer that has a large energy component, the transport to the supermarket, the utility bills within the supermarket, all of that feeding through into prices, and people's expectations of future prices going up considerably. That's the point where central banks will feel that they have to move interest rates to try and control those inflation expectations.
That's absolutely right. I mean, these things are a balance, aren't they? And everything is pushing upwards at the moment. You say there's nothing there to constrain inflation at this time. So the real danger is that those inflation expectations will get seriously ingrained. And I do want to talk to Maurizio in a minute about other commodities other than just oil, because I'm really quite concerned about the effect all this is going to have on fertilizer prices. You mentioned fertilizers a second ago, because I think that's really what's going to push this crisis off into softs. And you say the market is discounting a pretty benign outcome. I think that's right. I mean, do you the talks are being talked up by the American side and very much denied, it seems, still by the Iranian side, although conversations clearly are being had. The risk of the whole situation at the moment is it could be over in a finger snap. It would only take one tweet from Trump that and we're all so everything we're discussing could be out of date by this afternoon.
And that's the hope. The fact that the Americans are talking up the so-called negotiations, but they're definitely contacts via third-party countries, trying. The fact that the Americans are looking for the so-called off-ramp, looking for a way to end the conflict. I think they went into this without being completely clear what they wanted to achieve. Yeah, they can make the rubble bounce. They can bomb anything that they want. How much it actually helps them achieve their aims, it's just by bombing Iran doesn't change the political system in Iran and the leadership in Iran to something that the Americans would be more favorably disposed towards. So I think they've done, unless they are prepared to do a significant ground invasion, they've done everything, or they've achieved everything that they are going to achieve by an aerial bombardment. And we're all instantly into armchair general mode, but it's by looking at what the real objectives of the Americans and the Israelis are, leads us to some conclusions about when we can see this ending, or at least de-escalating.
I think we have to be armchair generals to a degree, because we have had very little in the way of a strategic explanation of what the strategic goals are, really. And one could assume the assumption was that the Iranian regime would collapse and, as you say, be replaced by something more amenable to the Western way of thinking. And it seems at the moment to me that the Iranian regime has not collapsed, and the extent to which it has partly collapsed, it is to be replaced by a regime which is less amenable to the Western way of thinking, is much more amenable to taking unilateral control of the Strait of Hormuz, and with the Houthis wading into the fight this weekend, taking control of the gates to the Red Sea at the other end. So I think this is a really quite a big concern. And I'd like to draw Maurizio in, really, to explain to us. I mean, I'm quite interested, Maurizio, in the extent to which oil can escape the general Middle East basin without going through the Straits of Hormuz. At the moment, I know there's a useful pipeline across the Saudi Arabian desert, but the Iranians seem very good at bombing things as well, quite accurately. If the American spy plane that was chopped in half by a drone over the weekend is anything to go by, so I think there are quite limited. I think there's a great potential here for a real commodity stalemate in the Gulf at the moment.
You're right, Andrew. The current situation in the Middle East, it's the biggest supply shock on oil that the modern world has experienced so far, even bigger than the big crisis following the Yom Kippur War in 1973. The problem is that out of the roughly 100 million barrels per day that are consumed across the world, about 20 million pass through the Strait of Hormuz. So it's a large chunk. And when you block that, it has a significant effect because the elasticity of oil demand is very low. So even when oil price rise, you continue to buy petrol, you continue to heat your home because are quite necessary activities. And so the longer the closure of the Strait of Hormuz continues, the higher the likelihood that there will be a sort of long-term repricing of the oil price. The oil price will remain above $100 per barrel for a quite long time. At the moment, as both you and Chris mentioned, there is theoretically the possibility that a negotiation will be successful and the Strait of Hormuz will be reopened. However, given what is actually occurring on the field, both in terms of hostilities and in targeting of energy and transport infrastructure in the area, doesn't look very likely that the conflict will end soon. And the length of the closure of the Strait of Hormuz may well have a quite significant impact both on the oil price and on the economy as a whole. You asked about the Red Sea, and one of the attempts that Saudi Arabia is doing at the moment, they have a pipeline, an oil pipeline that passes through the Persian Gulf to the Red Sea, and is trying to redirect some of his oil there. The pipeline has a capacity of about 7 million barrels per day, but two of these 2 millions are used for internal distribution in Saudi Arabia, so it's blocked. The remaining 5 have started just now, literally past week, to be uploaded in the Red Sea on oil tankers there. The problem that is concerning me is that the Red Sea has 2 openings, one north with the Suez Canal, and the one south where basically the majority of the oil tankers pass through, which is called the Strait of Ban al-Mandab, with a difficult name. And that strait is important not only for oil, because if Saudi Arabia want to redirect this 5 million, which will be a quarter of what the Strait of Hormuz usually see through, will have to remain open. And also through the strait, more importantly, passes through about 12% of world trade. So everything from commodities, transport of materials, goods, so a quite substantial chunk of world trade pass through there. The problem with the Strait of Ban al-Mandab is that on both sides of the coast, on Yemen and on the other side, what was used to be called Somalia, the territory, the land is controlled by the Houthis, which are an ally of Iran. Until now, the Houthis hadn't joined the conflict. They stayed quite silent. During the weekend, there were 2 missiles launched by the Houthis in Yemen toward Israel. And also there was a televised announcement where the Houthis said that they were joining the war. Now, it is unclear at this stage if that action has been made because they genuinely want to join Iran in attacking the entire Middle East and therefore blocking the Red Sea, or if it is just a sort of political signal to Saudi Arabia not to intervene in the war themselves militarily. As you well know, both Saudi Arabia, the United Arab Emirates, and Bahrain have remained quite on a standstill from a military point of view. They haven't attacked, they have just defended themselves. So this is the scenario at the moment, and we will find out during the next few weeks what will actually happen.
That is very interesting, especially the element that this could in fact be communication with Saudi Arabia. I wish I'd had the opportunity to invite a Lloyd's underwriter on as well this afternoon, so we could see what effect that announcement has had on the cost of insuring cargoes through the Red Sea, because that's another pain point. And as you say, a huge proportion, I think you said 12% of world trade passes through the Suez Canal. That's the high value trade. I know bulkers and low value trade already go around the Cape of Good Hope, but of course, if the container ships and product tankers and so on also are forced to pass around the Cape of Good Hope, I think that puts something like a 15 days extra on the trip on the voyage to Europe, and that uses a lot more. Guess what? Uses a lot more fuel. Where's the fuel going to come from? It just continues with that upwards pressure, and upwards pressure. It's going to leak out as Chris said in second and third order effects, if you like. I'm quite exercised myself, but in the effect this is having on commodities. I noticed just before we came on air that aluminium is already up 6% since the war started, since the conflict, should we call it, started. What I haven't done, now this is putting you on the spot, so I apologise for this. What I haven't done, and what I think I should have done, is put a graph of commodity prices, softs I'm thinking of, not hard, so that's agricultural commodities and so on, and see how the current situation compares to the shock those commodities experienced after the start of the Ukraine conflict. As I say, it's a little unfair to put you on the spot, but do you have any insight as to how much softs have moved?
Yes, not so much so far, at least some of the soft commodities. But the problem is, as you correctly mentioned, is the future months. This is seeding season for a lot of agricultural sites, from soya beans to wheat, etc., etc. And more than 20%, almost 30% of fertilizers produced in the world pass through the Strait of Hormuz. So at the moment, nearly a third of the fertilizers used by farmers across the world is not available, which means that the crops that we will have in after the summer will have a much lower yield, and therefore there will be, I wouldn't say a scarcity, but certainly a much smaller supply of a number of agricultural products on the market, and this, by definition, will increase prices. So the effect of the current war is not only on oil prices, but is also on agricultural prices going forward. It is on some of the other commodities, for example, thermal coal, which is used for both industrial uses, but mainly for production of electricity and in certain chemical activities, has already gone up by 20%, so in the past month. So this is an indication that there is a number of components of inflation indexes which either are now or are going to be negatively affected in future months.
Okay, thank you. Chris, obviously these rises in agricultural prices, which I think are only just getting started, are going to have quite a big impact on your sectors as well. Are you already seeing it leaking through into company performances, do you think, or should we be looking 3 or 6 months down the line?
Um, I think I think it's a longer term impact. And actually, for the companies that we invest in, there's some key agricultural commodities. So you look at the farming of cocoa beans in West Africa, you look at tobacco leaf as the bigger inputs, as well as coffee, which matters to a number of companies. Though those are the ones that materially affect the earnings of the companies that I invest in. And they've had elevated commodity prices for some time, partly structural, partly weather related. And those have been feeding through in inflation. When you buy your Easter eggs, you will see that the cost of chocolate is a lot more than it would be a year ago. Those commodities have been coming back down, and one of the things that the war may impact is that those commodities prices don't come down quite as quickly as forward curves would suggest. The more general agricultural commodities, in terms of everything that we buy when we go to a supermarket, that's more a pass through to consumers. So I worry less about the impact on the profitability of supermarkets. They will take their 3, 4, 5% margin on whatever we spend in the supermarket, depending on their position within the industry. They tend to be beneficiaries of inflation and higher food prices, with the percentage margin remaining more static. I think it's more the macro impact of squeezing out other economic activity and other spending that I worry a bit more about.
Yes, I think there's a degree to which the consumer can only absorb so much price rises in these areas, and people will forego that bar of chocolate on the train home from the office, which I succumb to periodically. But when I see it at Waterloo Station, they want to charge me £2 for a Mars bar. I don't need cheering up that much. I need cheering up, but not that much.
The companies have got very scientific and very clever at working out how much you will pay for that chocolate bar or bottle of Coke at Waterloo Station.
Yeah.
That what they talk about, price pack architecture and revenue growth management, using a lot of the data skills. And we talk about data a lot of the time when we're talking about AI and the investment there, but the data analysis and using it to determine elasticities, basically trying to work out in different environments how much you will be prepared to pay for that bar of chocolate. That's been one of the very good things that has helped the profitability of the consumer staples industry in general. I'm sort of going off subject a little bit from the war, but inflation and rising prices isn't necessarily a bad thing. When we look at companies, I like companies that can put up prices and get away with it. There are not that many of them out there.
That's one of your jobs, Chris, is to find me companies that can put up prices and get away with it. And I say I extend me to my clients and all of our clients, but that's your job to find the companies that can do that. I think it's interesting to see how much pushback there's been from both the grocers and, in fact, the oil companies in terms of political pressure that they've been put under in the current situation, with the sort of accusations of price gouging and so on. A little factoid I picked up on late night news last night was that that petrol prices at the pump are up 12% since the start of the war or the conflict, but actually the commodity input is up by 17%. So despite the screaming headlines, companies have absorbed a certain amount of that pricing pressure.
Yeah, I think we have interesting politics. Well, in this country and many countries, around blaming the oil company for the increase in the oil price caused by government actions. Well, U.S. government actions. So I don't think it's really fair, but it's not the first time that oil company executives will feel that the world hasn't been particularly fair towards them.
Ah, no. Well, I feel regularly persecuted myself, as I'm sure you do, and I'm sure Maurizio does as well. He probably feels very persecuted in the current environment because we all want to keep talking to him about what's happening with oil prices. I'd like to thank you both for your time very much. I've certainly found this chat interesting, and I hope our listeners have as well. If you did, I'd like you to review the show whenever you're listening and tag us on @Quilter Cheviot. To make sure you don't miss future episodes, tag the subscribe button. We'll be back next week. In the meantime, head over to our website, www.quiltercheviot.com, where you can read the accompanying market overviews, as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars on our website or on our social media pages. Finally, if you do have any questions to ask our experts for our next podcast, we would love to hear them. Again, you can pass those on to us via the comment page on our website. That's it for today. So thanks again, Chris. Thanks again, Maurizio. And thank you all for listening. Until next time.
This podcast is marketing material, not investment advice or research material. Investments can go up as well as down, and past performance isn't a guide to the future.